Let's go.
All right, welcome to Keys from Home to Home, Series 3, Episode 9. We have a special guest, Brent Anschultz, CPA that Lance and I know and love. Let's start by talking a little bit about what's gone on this last week.
Well, as you can see, I'm at the DMV in Columbia, Tennessee. There'll be a new driver in the Danmeyer household. So insurance rates are going up. Premiums will be going up, but in the mortgage world, lots of apps this week. Rates have continued to drift up. It's strange. Continuing to drift up from that September 6th low. Fed kind of is, maybe our guest will talk about this a little bit. Fed maybe is a little bit hawkish, maybe. I don't know. They may be holding back and not doing any more this year. We'll have to wait and see. We've got a lot of things to process. I know our guest, Brent Anschultz, CPA today, will be talking about that. How about you, Jennifer? What's rolling in your world?
Well, really quick, when I had 4 young drivers, my insurance was about the cost of a mortgage. So what's been going on this week? My listing in Tullahoma launched. If anybody's moving or PCSing, either one that way, it's a great house. You can get 2 links to that. I found out last night that I will be going to Virginia the week of Thanksgiving instead of Ohio to close down a house to celebrate a quickie marriage so that my daughter and her fiance can PCS together. So no new grandchildren expected. This is not a shotgun wedding. This is a fast, and I told her I wanted to be there, so we were able to do it. We're going to do it.
I saw that. Congrats.
Before Thanksgiving. Thank you. And then I'll be back to prep for a party for that game up north.
I'll be there. I'll be at that. Everyone, by the way, check out Jennifer. Maybe you can add it later on, but the video that Jennifer did for this listing in Tullahoma is fantastic. Really well done.
Thank you.
It's it really, and I think she's going to talk about that in an upcoming episode about what helped her to put that together. But I think in another life, she may have been a voiceover talent, but good. Make sure that link gets in there, Jennifer.
I will. I'll put it in the show notes. So, Mark, what's going on in you? Saving marriages, saving families?
Yeah, I mean, the growth on that couple that I've been working with is really just amazing. It's a 180-degree turn, and they're both focused. They're still going through their challenges of habit changing, which will take time and energy. Lance, thanks for letting me know that there's going to be another young driver on the roads in Tennessee. Because I live in Texas, I will not have to worry about that. So that's really what's going on in my world. And the last thing is really people are starting to, I am really seeing a lot of people concerned about being able to fund Christmas and the upcoming holidays. It's really taking on, I'm getting calls for how can you look at my budget? Can you look at my finances and find a way that we can fund the holidays without going further into debt? So I've had 3 of those phone calls just last week.
Yeah. Well, and it's a discussion about what's important for the holidays. Is it having a certain meal and maybe fewer presents? I mean, my kids, there were years that we didn't have a ton. It's getting on the same page with that. And once you do, you said this couple is making great strides. It's invigorating to know your path forward. Just the same way as when we're having people buy homes, like the young man that I helped buy a home this summer, he did not think that he could buy a home. And then when he found out what his range was, he didn't think he'd have much choices. And the first day we went out, of the 5 homes we saw, he's like, I'd live in 3 of these. And we were actually able to get him accepted offer on the first one he chose and close within 30 days. But once you know your plan and your path forward, it's invigorating. You know your steps, your and then it snowballs on itself.
Yeah, one specific thing happened yesterday just with that very scenario. So I walked, a client called, and he's got about $1,900 worth of debt. He knew, he called and was like, Mark, I think I'm going to get a loan through my company, 0% interest to pay, and I'm going to take a little bit of extra. And that right there is the entire portion of your mind thinking that I'm going to add a little bit more. I'm going to do a little bit more. I'm going to take a little bit more. That's the problem. That is the essence of where debt starts. And
it's
so,
only a little bit.
in a matter, I think we lost Lance, but
Yeah, I think he's finding out if Ethan passed.
yeah, real quick to finish that up. We workshopped the situation. In that discussion, we found out that he has 3 side gigs and it is set up to through a side hustle. And we laid out the paychecks. We laid out the amount that he can put towards it. We went from November, him taking a loan for about a little bit more, $3,000, $4,000 to pay off $1,600 because he wanted that bridge and that extra money, to paying it off from November 14th to December 15th with no loan. That is the workshopping that you get with someone who has professional coaching, and he figured out the plan. I just guided him through it.
And that bridge, that cushion, it's completely understandable. When you are stressed with debt, to think that, hey, I could get another $1,500 of a cushion of cash liquidity, it feels safe because you don't know that there's a structural foundation issue below it. And that's what you're being like a structural engineer going, hey, this brace right here is not as strong as you think it is to support your house. Brent, I know that's all in your wheelhouse. Tell us a little bit about what you've seen. And then for those of you who are new to the show, Lance and I obviously do mortgages and I do real estate. Brent, you were one of our clients. I think you were a little bit like that gentleman I was talking about. I don't know that you thought you were ready or should buy a home or anything. And that was 2 years ago. You were a little bit surprised. And then we're like, all right, let's go. And it was a let's go.
It was, yeah. And thank you, Jennifer, Mark, and Lance for having me on. So yeah, I'll give a quick background. So my wife and I lived in the community of Bridgeport here in Middle Tennessee, and we love it. You know, we rented a house here when we first moved here from California. Yes, we're one of those people that moved during COVID. And we loved it. And we told ourselves, if a house ever comes up for sale here, we should seriously consider doing it. So one Friday afternoon, my wife drives by on the same street that we live on, a house went up for sale. And we drove by it and we're like, okay, just, looked at the exterior. This looks fine. Let's put an offer on it. Let's just, what the heck, let's try. So I think it was Friday afternoon, Saturday morning, I think I called you, Jennifer, and was like, we want this house. What do we have to do? And you were like, all right, call Lance, get your pre-approval, and we'll go from there. So, and I think on Sunday is when we actually put the offer in because Lance was able to get us the pre-approval letter that night to be able to put an offer in. And then a month later, we bought the house. Yep. So,
you called me Saturday morning. We had known each other. We hadn't done a buyer's formal orientation, but we had done a networking group. So you knew the buyer path with me. We did the necessary paperwork. We went out and saw the house. You're like, we want to do it. Sunday morning, we put the offer in, and then we got you closed. Yeah.
Yeah. It was the least stressful experience, obviously stressful buying a house, but just for the simple fact that there were like no hiccups, you and Lance executed exactly what we wanted and you delivered. I mean, you couldn't ask for more in the transaction. So again, still to this day, super appreciative. But it was awesome. I mean, so happy that we live here. The joys and the ups and downs of home ownership have come with that journey, but wouldn't trade it for the world.
Well, thank you for that. And I have to say, one of the podcasts that's going to be coming up is things that we run into, difficulties in transactions for both realtor and then difficulties in transactions for lending. You were a stellar client. When we needed documents, you got us the documents. You got the documents to Lance that he needed. Right. When said, hey, we need to have insurance chosen by this day, you were like, okay, I get it. That's, sometimes we're like, oh, well, why do you need to see that? It's not because Lance is bored and wants to see extra paperwork. I mean,
Right.
just like when you're asking for documentation for taxes, it's not because you're bored and trying to like go, well, can I get into your business? You don't have time for that. It's just, I need this because government requires it or what have you. So speaking of that, government requires, everybody's favorite 3-letter word, or 5 if it's plural, taxes. Sure. There have been some changes. None of those are in place at this second, November of 25. Is that right?
Well, there are some that were retro. So the One Big Beautiful Bill. So let's do a little bit of background on it. So One Big Beautiful Bill, it was a reconciliation bill. So what a reconciliation bill is, it can only deal with things like revenue, spending, but it can't touch certain departments that have nothing to do with bringing in revenue or spending money. So the bill was designed basically to, one, reduce taxes and then incentivize manufacturing. To pay for those provisions, a lot of different changes were made. Speaking of real estate specifically, the biggest change was next year, you can now start to deduct mortgage insurance premiums. So one of the, spending, because technically a reduction of income is considered spending. So one of the spending provisions was now you can now deduct mortgage insurance premiums, which if you recall years ago, you were able to. So mortgage insurance premiums has been one of those things that's been here for a couple of years, gone a couple of years. And it's really just, what do we need to cut to spend money somewhere else? Or what do we need to cut to raise revenue, somewhere else? So it's kind of just one of those mediocre-ish items that, can be here one year, and gone another, but they've made it permanent. So starting in 2026, mortgage insurance premiums are now deductible. Now there's still a bunch of regulations pending on how to actually calculate that deduction, because the $750,000 mortgage principal limitation is now made permanent as well. So the question is, let's say you pay mortgage insurance premiums on a mortgage that's $1 million. Are the mortgage insurance premiums also going to be limited as well? So we're still waiting some regulations, but by and large here in Middle Tennessee, your average house, $500,000-$600,000. You pay mortgage insurance premiums, those will now be deductible, which is really nice.
So 2 questions on that. Yeah. They're deductible for the filings for 2025 that we're going to be doing in 26?
No, they will be deductible for the filings we're going to do in 27 for 2026.
Okay. And what document is going to be the document that you're probably going to need to see for that? Will they be sending out, I get an interest statement from my mortgage company. Will they be a line item on that or something?
Yeah, so kind of funny. It's always been a line item on the mortgage interest statement. So for example, last year, I paid mortgage insurance premiums, but it was just listed as a number. I couldn't do anything with it. So they've always been listed, but now you'll actually be able to deduct them as an itemized deduction.
Okay, very good. So what else is going on? Is there anything that was in the bill that somebody needs to take action on before the end of 25 for their 26 filings?
Yeah, really good question. So one of the biggest changes that will affect homeowners will be the loss of the solar credit. So if you live in a state that heavily incentivizes solar, so I'll speak to California. Well, that's the biggest one. California is really the most incentivized. Colorado is also really big incentives as well. If you don't buy a system, place it in service by the end of this year, you no longer qualify for the 30% credit. So if anyone is on the fence, should I do solar? Should I not? You better do it this year. Otherwise, you're going to lose that 30% tax credit for next year.
Interesting, because my yard that I'm here, I had to actually move to a different room for this podcast because now that the sun angle is different, remind me to tell you about my daylight savings rant. We have a lot of sun on this yard, and we're talking about putting solar on our outbuilding. Yeah. But the outbuilding I have right now is ancient as the days, so we're doing it on the new one. So we won't get any benefit because we're not going to be building that building for a few
Right.
years. I mean, there's still benefits to it, but yes. Okay. Interesting.
Yeah.
And just a really quick blurb, Tennessee does not have a lot of solar panels.
Mm-hmm.
Solar panels have caused massive headaches on sales in some situations.
Oh, really?
Yes, because they are financed, an attached item to the home.
Right.
So you're approved for history major math. You're approved for a $1,500 mortgage, and your income to debt ratio only allows you $200 more dollars. But the solar panels that are on your house that you now have to assume that loan for are 400. You have now shot that deal because you're 200 above your debt to income ratio.
Right.
There have been massive problems with that. So, and then like if a seller's wanting to pay it off, sometimes they don't have that ability to do it. So it's been problematic.
Sure.
So we always say if you come up to a home with solar panels, you really need, as a listing agent, you need to do your prep so an appropriate buyer can buy it. All right. So that's one thing that's changed. Is there anything else that's like, hey, get on the stick right now?
In terms of real estate, not
just
really.
in general, even
in general, well, for business owners, this is this was a very business owner friendly bill.
Okay.
One of the biggest benefits for business owners now is something called bonus depreciation. So bonus depreciation is, so I guess this does apply to real estate. So if you own a rental, for example, so let's just say, you own a few rentals, and then you do a cost segregation study. So, you buy a rental property, say $600,000. You do a cost segregation study on that rental property. Bonus depreciation will now allow you to take 100% of the expense of 5, 7, 15-year assets, which in layman's terms is like fixtures, appliances, things that aren't actually a structural part of the roof and the four sides of the house. The government will allow you to fully expense the portion of your purchase price of that house in the first year that you place it into service. So what does that mean exactly? So let's just say you buy a $600,000 house. Well, instead of depreciating the building portion of that house over 27 and a half years, maybe 15% of that building now you can write off in the first year. So let's say you had net positive income on paper. So let's see, your rental income minus your rental expenses, you came up with a positive number, which is great. I mean, that's the idea.
Right.
Well, when you add that depreciation back in from all of the bonus that you were eligible for, well, now you have a loss for the year, or you brought your income down to zero depending on your tax situation, and now you basically pay no tax on the income from that house.
Oh my God.
That year.
Okay, so that really hits home for me. I have 2 rental properties. Actually, in this year, I had 3. A portion of this year, I had 3.
Sure.
So and I've been depreciating, appliances, etc., for things that I've purchased for these homes. These homes have been rental properties for 10 to 12 years.
Sure.
So what I'm hearing is I can now go for bonus depreciation on these assets for 2020 when I do my taxes for 2026.
It would be for anything placed into service after, I want to say, January 19th of 25. So there is a cutoff of when this special bonus provision actually applies. So like, let's say you were to buy the rental property in February or March. Then you did a cost segregation study, and then you were able to segregate out the 5, 7, 15-year assets. Then you can apply the 100% bonus depreciation on those assets for your new rental property.
What if he has
I have a property that I put into service in 2024.
Okay. So 2024, you could still do a cost segregation study and go back and do that, but you wouldn't get the 100% bonus. You would get 60% bonus. So pre One Big Beautiful Bill, the bonus depreciation was slated to go back down to 0. 2024 was 60%. 2025 would have been 40%. But you can go back and you can do a cost segregation study on that rental property and accelerate that depreciation for 2024.
Who do I contact to do a cost aggregation analysis?
Yeah, cost. So cost segregation studies are really, it's more of engineering when you actually look at the mechanics of the study. So there's companies out there that, and I have a couple resources that I use for my clients that you can actually just go online and you can do a cost segregation study online for like a single family home. So for the average real estate investor, it's actually not that cost prohibitive, but the benefits can be, outstanding.
All right, I have two
Do you have
questions.
any? Sorry, Jennifer. Do you have any of those resources in Texas?
Yeah, so there's a resource that it's an online tool that works in all 50 states through a company that I can send out to you. I don't have it on hand, but I want to say that their studies are anywhere from $500 to $700 per property, which is really great, as opposed to hiring a company, them sending someone out, to actually look at the property and do all the calculations. It's a fourth of the cost essentially, and it's a great online tool.
Yeah, if you can
We'll
send
put your contact information in the notes as well. Do you have a Calendarly connection for people who want to book a time with you?
I don't, but I really should.
Okay. Well, we'll put your phone number or your email or whatever you
Okay.
prefer in there. Now, I have a question for you as well. So let's say that Mark already has his homes for 10 years.
Yeah.
But he's had to put on a new roof or bought the refrigerator. Are those individual items able to be depreciated the way you're talking about?
So over the years, every improvement that you make, you buy appliances, those would be depreciated at whatever rate. If it's a roof, it'd be 27 and a half.
That's what I thought. Okay.
Yeah.
So if he's had to buy a refrigerator or all new kitchen appliances
Right.
in his rental since February of 25, all of that's 100% potentially deductible the way you're talking about it.
Depending on the asset.
Yeah. Okay. Now, the other question I have, Lance, can you hear me?
Yes.
Okay. If somebody were to take some of the deductions so that their income was lowered or zero or a loss, that is going to affect their income if they were going to be buying a house this year, right? So they
No.
need, or is that income you might be looking at, Lance?
Absolutely, and that's why they have Brent to guide them along, to tell them what may or may not be the right way to do it. In fact, Brent referred me someone this year that has the exact same circumstance. They're coming from a industry they were very successful at. They went and started their own company doing this and have been, to say successful would be a complete understatement. They've blown it out of the water, and they're going to have some serious taxation things to deal with, but they still want to qualify to buy a home. And in that instance, Brent and Jennifer,
Oh, you cut out on your vocals. We can't hear you. Lance, can you hear us? Lance. Lance. Can't hear you.
can you hear me now?
Yes.
Yep.
Okay,
That was
you
weird.
cut out at the most critical part. Try again.
I don't know what you couldn't hear.
In
Did you say
those
that?
instances, you need to talk to you is where we're going, I think.
Yeah, I was saying that Brent had actually referred me someone this year that is a circumstance like that. The guy started his own company, coming from a business he was very successful in, and he started this new company, and he has, to say he's been successful is an understatement. He's made tenfold what he made the year before. And Brent contacted me and said, how are we going to address this? So for this person, yes, Jennifer, we're going to be looking at those things. But I wanted to plug and say that for that particular person, we may look at a non-QM, a non-qualified route, where it's more of the bank statement loan type of thing that you've heard about. This particular person has assets. It might be the best way to go, as opposed to just massive taxation. And I think Brent has been talking about some of those changes maybe for that person.
Yeah. It's just like when people used to not claim their tips. I'm like, okay, first of all, you need to be claiming your tips, but also you need it for the income when you're buying a home. That was one of the things that we talked about a ton on that. All right, Brent, are there things coming up that as people are working on their budget for 26, they're working on their plans for 26, we've always done it this way, or for 5 years, we've done it this way, that we need to now, in moving forward in 26, be doing something different?
Yeah, and I'm sure all of you have been keenly aware of what's been going on with the government and the healthcare subsidies and things like that. So, to be honest with you, the biggest change going forward is going to be one, the loss of the enhanced subsidies, because it's not looking likely that those are going to be extended. And when I say subsidies, I'm talking about the Affordable Care Act, marketplace subsidies, along with the rate increases on marketplace insurance. So let me paint an example for you. So I have a client of mine that previously was paying about $800 a month for their family. You know, they're in their 50s. They have a kid that's in college. So not the cheapest in terms of rate classes for insurance. When you combine the premium increase and the loss of the enhanced subsidies, their monthly cost was going to go from $800 a month to $2,600 a month.
Yeah.
I mean, we're talking a threefold increase of premium increases.
And it's from the loss of the subsidies. And when we had 2 weeks ago, we had our health insurance guy on. And just to give you an example, I'm 58. I have no pre-existing. I have no meds. My ACA plan was like $1,100 for 26. No subsidies. But if I went off market, almost the exact same plan was $560.
Yeah.
So, I mean, I get all sides. We try not to be political. I get all sides. And I'm not going to go into who's doing whatever, but it is something you have to plan for because these changes are coming.
Yeah. And, you know, the One Big Beautiful Bill did make one positive change in that aspect. So they kind of foresaw this happening. Mm-hmm. The nice thing is, though, is if you go to a bronze level plan. So what a bronze level plan is, the lowest amount of cost sharing that the insurance company picks up. So, for example, you know, let's just say, you know, if you had to go to the doctor, you paid your deductible, you know, the insurance company would pay 60%, you would pay 40% until you hit your out-of-pocket max. So the lowest tier possible. Now, any and all bronze plans are now HSA eligible. So what an HSA is, a health savings account, which is probably, to be honest with you, one of the most powerful tax savings tools and generational tax saving tools available. So it incentivizes more people to go to a bronze level plan. If you're healthy, go to the doctor once or twice a year. Honestly, you're probably better off doing that. And then using your HSA to pay for any out-of-pocket costs that you have for the year.
You need to go back and look at that episode and his name is Joe Graves, and give that to that family that's going to 2,600, because I strongly suspect he has a plan equal or better that would cost them less.
Sure.
The other thing I want to add to this too is don't be afraid. I mean, I know insurance is a good defense, but don't be afraid to ask if you're looking at how to get to that deductible and that out-of-pocket cost. I mean, if there's some things that you can offset, ask about self-pay, because the self-pay version of some of these costs are ridiculously low, and it might be advantageous if you're having to reach a deductible or an out-of-pocket cost anyway. It may be just, you know, and you're healthy and you're not going to the doctor a whole lot. Mm-hmm. It might just be easier to pay for the cost of it as self-pay.
That's what I did for years. When ACA first came in, I actually took the hit on the tax penalty.
Sure.
Because my ACA plan was going to be like $800, I think, a month for me.
Wow.
Because of my income and everything else. And I'm like, what? And I mean, you know, with having to set aside money for taxes and everything else, you're talking, I'm paying like $8,000 to $10,000 a year. And then having to, like, I don't go to the doctor often. If I get strep or, you know, I'm doing my, annual kind of things, I do it like every 2 to 3 years. It made no sense for me to do that. It was better for me to go to a walk-in clinic and say, oh, you have strep, pay $300 rather than pay $800 month after month. But I knew I was rolling the dice if something major would have happened, and I didn't like it. So now I have like a major medical. What else are changes coming up in either 26 or 27 long-term planning?
Yeah, you know, So what the bill did is it increased the standard deduction, increased the child tax credit. A lot of people now are probably not going to be itemizing, because of the increase. One of the nice things, though, is that it did bring back a COVID era provision where you could deduct charitable contributions without having to itemize. So I want to say it's $1,000 if you're single or $2,000 if you're married filing jointly of what you can deduct without itemizing, which is really nice. So if you're charitably inclined, but you always take the standard deduction, at least now okay, I'll get a little bit of benefit from doing that.
Okay, so history major math here. The standard deductible for a single is what?
Oh, it's fifth. I don't know the numbers off the top of my head, but I want to say for jointly it's like 31.5. Don't quote me on that. It's up for next year. So half of that would be for a single person.
Okay, so let's say it's a couple, 31.5. So I have my deduction. I'm not doing all my little receipts and everything else, but then I've given $1,000 to Stronger Than My Father this year. Right. So I do the 3,100 plus the 1,000.
Correct.
Okay, lovely. And then are there other things that people should be getting with okay, so I'll bring this up briefly too. You help people structure businesses so that should there be an LLC? Should they be a, whatever they should be in Tennessee or in California? Because in some states you might need to be an LLC and in some states you might need to be something else. So you can help people with that, which is great to know. I saw recently, and I need to talk to my trust lawyer, there was a change in 23 or 24 that trusts are no longer being the same protection vehicle for inheritance taxes as they had been. And it was a really quick blurb and I didn't know much about it. So I'm going to ask some lawyers I know, but is that on your radar?
Okay. No, to my knowledge, no. I have not heard anything like that. No,
okay, I'll follow up with everybody and let you know about that. Are there any other things that coming up towards the end of the year and planning to 26 and the big beautiful bill and just life in general that we should be talking about, knowing, et cetera, et cetera? Or the other thing is, we'll answer that first and then I'll ask the next question. Sure.
Yeah, with anything, I always tell, with my clients, I do something called year-end tax planning. So, whether if you don't have a CPA or some tax advisor, I really recommend getting one, especially if you own a business. I mean, if you own a business, 100% of the time, I'll get a client that, previously did their tax return on their own. Inevitably, there's going to be things that were done incorrectly.
That was actually my next question. I said I'd hold on. What are the biggest things that you see Bobo heads doing?
Yeah.
Either because they did it on their own or because they did it with someone who wasn't in it day in, day out, day in, day out.
Yeah, and I'll put this in the context of mortgage lending, for example. Yeah. So a lot of the times what I'll see is, deductions that are either overstated or incomes understated. So what happens is, a taxpayer will go out, they'll apply for a loan. The underwriter comes back and says, this doesn't look right, or, explain your income, explain your deductions. And the client has no idea how to do it because, they kind of estimated, this is what I thought my income was. This is what I thought my expenses were. And then they lose the loan because they can't provide, proper documentation. So a lot of the times I will get clients, that need a CPA to do their taxes, to do their bookkeeping, for the simple fact that, someone's going to be looking at it. And, they need to know that when it goes to underwriting, if the underwriter has questions, okay, the CPA can explain X, Y, Z. This is why income is this. This is why there's a loss, for, whatever the case may be.
Okay. Now, one of the things that we say a lot on our show is friends don't let friends. Call 800 numbers.
Yeah. Call 800 numbers. Yeah.
So we all hear commercials for all of our fields about you should be using this person over here to do it. So one of the things that we frequently hear when it comes to tax filings that I hear a lot on commercials is, let us review your previous year taxes to see what you've done wrong. So let's say that I wasn't taking a deduction that I should have or could have been taking. Or let's say I was taking something that I should not have been.
Yeah.
That's a scary, like for me, that's a scary thought, because my dad was a business owner. I saw him get twice audited by the IRS. And I don't know if it was just his reaction to it. I mean, he like hates the IRS, like hates them, you know? It's a scary thought for me because of what I saw him going through, to either be revising, oh my God, is that going to trigger an audit?
Sure.
But what is the truth? Can you come in and fix something that you did on a taxes? Like, hey, you actually should have been doing this and claiming it this way. And then obviously, like, hey, you should have done this, and this may actually result in an interest or penalty or something.
Yeah.
Talk to us a little bit about that. Relieve my fear and maybe others.
Sure. Yeah, there's two sides to the token. So, I'll speak to what you had brought up. So two examples. First example is someone prepared their own return and forgot to include expenses. So you are fully entitled under, the Internal Revenue Code. If you had expenses, you can provide support for them. You're entitled to deduct them. They're necessary and ordinary. There is nothing wrong with going back and fixing a return that missed expenses. You understated your expenses. You can substantiate them. Nothing wrong with that. The only thing I would speak to that, though, is how material are those expenses? Mm-hmm. So here is what happens when you submit an amended tax return. It is a different process than if you were to file an originally filed return. So if you were to file, your 2024 tax return, original copy, pretty much nobody's going to look at it. The machine, it's going to go through the IRS 70s machine and, calculate, match up your tax documents with your return. And then if you're entitled to refund, it'll issue out the refund. If not,
check it tracks. Yeah.
Exactly. So there's really no human interaction with an original return. When you amend a return, however, eyes start looking at that return. So inevitably, someone in the IRS system has to go in and look at the changes of that return and has to say, okay, do the changes line up with the changes in your explanation and stuff like that? So it does receive a level of scrutiny. So the reason I said, are the expenses material? If we're talking, we're missing 1,000, 2,000 of expenses, is that worth the risk of the IRS saying, hey, we got your amended return, we want to examine X, Y, Z items? Because that can happen. That can very well happen. Now, if it's, I forgot to add 50,000 of expenses, well, that's a material amount of expenses. I would amend for that. I would amend for that level of expense, just with the caveat, though, that the IRS may ask questions.
Right.
Yeah.
And I would think, too, that one of the best benefits of coming in and bringing you, like, let's say I'm going to come to you, right? I'm like, all right, It's December, it's year-end planning, it's business, This is what we're talking about. And I'm going to bring you my 23, 24, so we can be looking at 25 and planning for 26. There may be things that you're like, Jennifer, Jesus, you shouldn't have been doing it this way. Likely, you know what I mean? And we're not going to amend it, but we're sure going to make sure we address it for 25.
Right. And what a lot of taxpayers, they have this kind of, I think a misconception is, it's going to raise flags if you change something in, a future year as opposed to.
I do it different than I have.
Do differently. Not necessarily true. I mean, the IRS cares more. Are you doing things correctly now? They are not going to be more or less upset for you fixing things as soon as you catch it. Now, if it's a material item that, hey, you deducted $40,000 of expenses and, you really shouldn't have, well, it's an uncomfortable conversation that I have to have with my clients and say, look, if the IRS examines you, they're going to disallow these expenses and then you're going to be subject to tax, interest penalties, whatever the case may be. So as my job is to look at those prior returns and be like, okay, this is what I see. This is what I recommend you do, but I can't really force someone to do it. I can't force someone to say, hey, we have to file an amended return. Because again, I'm not the taxpayer. The taxpayer is the one that's ultimately responsible.
So it's not like when you see child abuse that you have to report it, or when Lance or I are like, this might be mortgage fraud and we can't play this game with you. It's a different kind of scenario. You can't be involved in them defrauding the government, but you can't make them change something. All right, so that makes sense. Now, I'm going to ask you kind of a joke question, and then I'm going to tell you guys a quick rant. What would happen to the CPA world in the United States if they were to ever repeal the income taxes? Like, there's no more income tax.
Sure. Yeah, to be honest with you, we would really just pivot. So here's what would happen. And that's a great question, because it's something that, I talk to my business partners about and contemplate with clients all the time. What would happen if we repealed the income tax? Well, let's look at where the states get their money from. The states by large part get their money from the federal government. So let's say the federal government stopped paying the states had to come up with that revenue on their own. I can guarantee you, if Tennessee lost all of its federal revenue or most of its federal revenue, we would have an income tax. So what you would see is really a resurgence of income tax through the states. So essentially, we would pivot we start from your federal income tax to get to your state income tax. We would pretty much, I would probably argue that our job would be harder, because now we're dealing with just as a complex income tax for each state. Now we have 50 states that we have to worry about instead of, let's say, 35 that have an income tax. So
do you think that the states or the federal government would be more efficient with monies? I'm just teasing. Don't answer that if you don't want to.
To be honest,
I'm just going back to the Federalist and Anti-Federalist discussion.
Yeah, I know.
Read the books.
I know. No, it's a good question though, and it's something that it's always in the back of our mind. Oh, what happens if the IRS eliminates income tax? Well, the money's got to come from somewhere. So it's as who is it? Nothing certain but death and taxes. Yeah. It's not going away.
Yeah, exactly. Well, and we didn't have income taxes until after the Civil War. I think it was 1870 that was when we had income taxes. We had other sorts of taxes. All right. So really quick, I promised at the beginning, I hinted that I was going to tell you about a rant. So this will be the official launch of Jen's Sunshine Revolt. Okay. There are like 18 to 20 states that have passed the repeal of daylight savings. Did you know this? There are some states that don't play with it, but there are like 18 to 20 that are waiting to enact their repeal of daylight savings. Yeah. And I'm talking about this because I don't mind getting up early. I'm actually very invigorated in the morning. But what I am irritated beyond belief about for this last week is at 6 o'clock, I'm like, geez, dark outside. I don't want to do anything, right? I would like to be a little more productive. So do you know why these things have not been moved forward? These 18 states are still on daylight savings. The Fed has to pass their part. The Senate has passed their part. Trump has said he'll pass his part. We're waiting on the House to bring the motion to the floor so that it can be voted on. So you will in the future soon see daylight media video from me that if you live in these states, call your House, United States House congressional person and demand that they bring it to the floor because I'm tired of daylight savings. So there's Jen's rant. Are you with me, gentlemen?
Yeah, we should get rid of it.
It doesn't matter to me. I mean, it is what it is.
Sunshine Revolt.
I don't know. Yeah. I kind of like it. To me,
I'm cutting your mic.
I mean, I got to go back to me. It's like the season changing. It's the feeling of okay, yeah, you know what? We're headed to winter time, and
that's because you're in Texas. You're close to the equator.
Yeah.
But daylight's different anyway.
Yeah, but I grew up in Wyoming, so I mean, I hear what you're saying. I mean, at 5 o'clock, 6 o'clock.
You stand in the way of the revolution. If you won't join it, would you just step out of the way?
I'll just kindly move out of the.
Can you see why my ancestors were in the American Revolution? Is it obvious at all?
I mean, if I recall, the daylight savings had to do with farming, right?
It did have a lot to do with farming.
Yeah.
There is some discussion that there was some more maritime things going on too, but not as much.
I mean, it's what, 2025 or almost in 2026. I mean, yes, we still have a lot of farmers, but I would probably say it doesn't really affect them as much anymore. So let's throw it out.
Well, and we do so much in the evenings. Even farmers, they're going to be doing more in the evening than when it used to be sundown, you're done. That's fine. Cozy up time, which I like that idea, but we just have a lot that we're doing now. All right. So previews for the upcoming one. If you have older family members that you are going to be seeing for the holidays, whether it's Thanksgiving, Christmas, New Year's, or any other holiday that you celebrate, this is the time that a lot of people are not just having a phone call or an hour-long visit with family, they're having extended visits. I'm going to be speaking on our next episode about what to be watching for, discussions to be having. I do senior move management on top of real estate. So is this the time that we talk about silly things that can be contentious? The gravy boat that we always use at Thanksgiving, the salt and pepper shakers, that, the little pilgrims that came down from grandma that mom now has. Do we need to talk about some of those things? How is mom doing? How is dad doing? Mentally and physically, are they in a place where their home is still doing well with them? So I'm going to be talking about a lot of that on the episode that will air the Monday of Thanksgiving week.
Very good. Yeah, I mean, I think there's some content that I can add to that discussion, just based on what I do as a coach, financial coach.
Yeah. Well, sometimes you got to step in and help your parents with your finances. I know I have multiple friends who have had to help their parents automate, or like my dad's still competent to pay his bills. My mom's not very involved in it because it's all on the computer. But this is that time to have the conversation. Hey, Dad, where are your passwords?
Well,
so that if something happens to you, we can still be, I'm not talking die, just even in the hospital, can I get your bills paid for you?
There's a deeper conversation to this too. And I'll introduce probably an acronym that I'll share the acronym now. It's DWMA. We follow that. I try to follow that mindset. So what that means is daily, weekly, monthly, annual. And it's a process, but I can add content to it, Jennifer. So I'm looking forward to it.
Sounds good. Hey, Brent, anything that we didn't touch on that you wanted to share with us? I've got your phone number on the ticker that's been going across, the 661-714-4317. Yeah. Is that the best contact method for you, or what is the best contact method?
It is. Yeah, that's my cell phone number.
Okay. And you're not just Tennessee and California. You do things in, what are the states, if any, that you don't play in? Or the
I
ones
play
you do
all 50 states.
Okay, that's fine. And then do you do people in territories? Like, is that a thing too?
Yeah, definitely.
Okay. Like, I don't know. All right. So perfect. So I'll make sure that we put that in there. And then this will, we release on Mondays, we pre-film. So if any of you guys have any questions, absolutely recommend Brent. He is great, very knowledgeable. As he said, in multiple locations, all 50 states. He's in the Sunshine Revolt. That's most important. All right. So until next week, everybody have fun. We're warming up, so we don't have to worry about staying warm as much. So take care, y'all.
Thank you.
Bye, everyone.
Bye.